Thank you, Mr. Chairman, and thank you, Mr. Lewis, for being here. A couple of questions. My understanding is that the original transaction started out as a private deal between Bank of America and Merrill Lynch, correct?
Yes.
And you did the due diligence financial review to make you come to the conclusion that it was in the best interest of the shareholders of Bank of America to proceed,
yes.
correct?
Yes, that's correct.
And then sometime after you made this decision, you became aware of the $12 billion additional hole in the balance sheet. Is that correct?
Yes.
And that was on December 14th of 2008?
That's when we saw the accelerating losses.
Well, that's when the accelerating as in $12 billion additional.
Correct. Yes.
Okay. Now, your shareholders had already voted to approve the merger based on information that you had provided up to that point. Is that correct?
Yes.
But the $12 billion figure that you became aware of on December 14th was of such magnitude that it made you believe that in your capacity as the CEO, you would have to consider invoking the MAC clause. Is that correct?
Yes, sir.
And is it fair to say that the MAC clause would be considered, in effect, the nuclear option?
I don't know.
Well, here's what I mean. If you invoke the MAC clause to get out of a deal that you entered into, then there's obviously reputational consequences in litigation, correct?
There is, yes, sir, there is that possibility.
And if you lose the litigation, there are financial consequences to your shareholders, correct?
Yes, sir.
So you wouldn't even consider invoking the MAC clause unless there was something of enormous magnitude and consequence to the company and the shareholders, correct?
That's correct.
Now, in order to invoke the MAC clause and avoid the consequences of perhaps losing, would it be prudent in the ordinary course to get financial advice from your financial advisors as to the impact of this $12 billion hole on the business plan that justified the original decision to enter into the agreement?
Well, we had finance people looking at all of that. I mean, so we were looking at that issue.
Well, obviously, this is my question. If you found out about a $12 billion additional hole, whatever model you had about payback and value to the shareholders now was called into question, right?
I tried to mention this before, but it extended the amount of time that you were going to get your payback, yes.
It affected shareholder value, correct?
Correct.
All right. Basically, two questions. One, did you get a financial analysis that you reviewed before you made a decision to discuss with the Treasury officials the invocation of the MAC resource?
There was financial analysis that I saw, yes.
Okay. These are made available to you.
They were, yes.
And what was the conclusion of those financial analysis?
The conclusion was that you pushed out your payback or your accretion because you had these preferred shares now that you were having to pay back.
Well, but that's obvious. I mean, the bottom line is, was there a conclusion about what the viability of this transaction was?
Well, we still felt very strongly that all the strategic issues that were being addressed prior to Merrill Lynch were being addressed by the acquisition of Merrill Lynch.
Have you made these financial studies available to the committee for its review?
I don't know. I don't know what this committee has.
All right. So what you're saying is that you did review financial statements from your advisors, those being whom, by the way?
Our financial advisors are us.
So all internal. Right. And on the basis of that, you decided that despite the knowledge of the $12 billion hole, it was prudent to proceed, correct?
Yes, sir.
All right. So whatever threat or whatever word it is we're going to use for Mr. Bernanke and Mr. Paulson interactions, you'd come to an independent conclusion on the basis of financial review by your people that it still made sense for your for your shareholders to proceed, correct?
No. As I recall, they were done in the context of the receiving the money.
Let's be clear. You're saying two things now. One, you did an independent financial analysis that said it'll stretch out the payback time, but it still was prudent to proceed. But on the other hand, you had Bernanke and Paulson breathing down your neck, so that was a factor. Are you saying those two things?
No, I don't think I am. I'm trying to say that we...
Okay, I'm going to interrupt. I don't understand that because I think you have said those two things. Another thing that is very important, I think, to shareholders, $12 billion is of consequence to you, correct?
Yes, it is.
Did you tell your shareholders that you would come upon this information that the deal they voted on is not the deal that was going through because it had a $12 billion hole that was accelerating? Did you tell them that?
The $12 billion was what we discovered later.
And do you think after-the-fact information is not of interest to investors?
What I do know is that when our lawyers tell us we have a disclosable event, we disclose it.
Okay, if you
if
I can ask just one final question. If there is an event that you consider so significant that it may allow you to invoke the material adverse consequence contract clause, do you not think that same event is of interest to shareholders and requires you in your fiduciary duty to disclose it?
I'd leave that decision to our security lawyers and our outside counsel.
You're not CEO?
I'm not a securities lawyer.
You're not the ultimately one responsible?
I have to interrupt the gentleman.
Okay.
We have
Thank
votes
you.
and we have other members who have not had an opportunity.